Hello everyone. Today the topic of discussion is financial management. As all of you know that business is going to stay and the only alternative to the employment in current scenario is to go ahead and create as many as business opportunities as possible. So what is the basic motivation behind having a business, well-established business for that matter? The one and only motivation for any businessman across the world is to be able to generate profit, because that is what he's looking for. That's the ultimate motive. Of course, the secondary motive is definitely as providing service to the consumers, but that also is basically means to generate the profit. Okay. Of course, in the process, they're also generating a lot of employment. But again, as I told you, the financial motive is one of the prime motive of any business creation across the globe. So let us now understand how to establish the profitability. Because if you do not get profit, there is no use of getting into the business activities and just simply wasting your time, energy, and money. So one of the basic tool, the management tool, is the financial accounting, through which any business can identify and will know the what is going on in the business operations and what is the financial health of the organization. So basically, financial accounting, therefore, is a set of concepts and conventions, or the protocols, or whatever you call it, or a system that has been established in order to apply across the globe by all the businessmen per se. So this makes them aware of what is the financial liability, what is the financial health for that matter, and whether they can continue their business for so long, or they have to stop the business if it is incurring heavy losses. So today's the moot point is what is the financial accounting and what are its basic principles, concepts, and conventions, and how it is being applied across the businesses in the country. So we'll just be having a detailed discussion of all the principles that are being in place, and universally applied, irrespective of which country you're living in. The set of principles remains same. So we'll be having a discussion on that. So hi, I'm Professor P.K. Pathak. I'm back with you with a new topic, and hopefully you must be enjoying all my previous videos. In case you have not watched it before, you may log into my YouTube channel and just continue watching all these useful videos, which will definitely improve your awareness about these common topics, and also some of the students who are pursuing these topics as a subject of study, they may get benefited in the process. So before again I start my topic, I'll urge all of you to like, share, and subscribe to my channel. And on that note, I'm going to share my slides about today's topic. I think it's visible to all of you. This is the topic of the day, generally accepted accounting principles, and this is a way of getting enrolled into the basics of the accounting, and which is what is a prerequisite for anybody who's trying to explore the further possibilities in the financial management or the corporate finance. So let us go ahead. What is financial accounting for that matter? So this is basically an act of recording, analyzing, and reporting all business transactions that are being done in a company. So basically, a company is involving into a lot of business transactions, and they're all in monetary terms. So every transaction is to be recorded, it should be analyzed, and it should be reported to the people to whom it matters. So further, we'll be exploring in the details in the following slides. And what is the purpose of all this recording, analyzing, and reporting? The purpose is to generate the statements, financial statements such as profit and loss account, balance sheet, the fund flow statement, the cash flow statements, etc. And all these things, all these information are being used by various stockholders. Now, who are all these stockholders? Stakeholders. The stakeholders could be the shareholders of the company, the employees of the company, the customers of the company, and all those people who are directly or indirectly associated with the company for that. So what is the purpose? Everybody has got a different purpose. While the shareholders' purpose could be whether or not their money is growing, their capital invested is growing. The employees also may be interested to know whether the company is overall growing or not, because the employee's future lies in that. So similarly, the customers might have a different interest whether or not the company is doing well, so that they can have their own option, open to switch to some other company if this is not doing well. Okay. So let us go ahead further. Generally accepted accounting principles, as we call them, they define certain standards and protocols for universal applicability cases. Otherwise, what will happen if somebody is applying, if in a different country, different principle is being applied. In our country, some different principle is applied, or even within the country, in some states, a different principle is applied, and in some other state, different principle is applied. Then how you are going to have a uniformity? I mean, it doesn't make any sense. You see, for somebody, different standards have been set out, and if you happen to interpret somebody else's financial account, their standard protocols may be different, and so therefore you might be confused. So how they actually ensure the consistency in maintaining the financial records around the globe. Okay, so irrespective of whether you are here or you are in USA or in London, everywhere you can see the balance sheet. They are commonly being, prepared in the same fashion. So the interpretation makes very easy to interpret all these reports and to make certain inferences. So the point is how the accounting principles could be made more acceptable. If these accounting principles are based on the realistic assumptions which is happening in the world today during the original operations, they're also supposed to be simple, understandable, and explanatory. So the moment you see a statement, you must be able to understand what exactly the statement is telling. It must be followed with a consistency. So wherever you are following the accounting principles, you must be consistent. So if you are following a certain pattern, you should be consistent in the next year also with the same pattern. The accounting principle must also be able to reflect the future predictions, because businesses are being created on future predictions. You see, in case whatever product you require it today, the companies might have manufactured it a few months back or few weeks back. So that's why it is available in the market and you happen to go and buy it. So did the company people, they came and asked you 2 months before that, look, what you will be requiring after 2 months? No, definitely not. They made a market survey. They identified the consumer demand in general. They identified that so many quantities will be required, and they manufactured all those quantities and made it available for you to buy today. So future projection as what is the basic need. The companies need to anticipate. The companies need to make a forecast, and still accordingly they have to produce in the bulks or in the certain quantities. And ultimately, all these principles must be able to generate some of the information which should be useful to all the users. To be more precise, the stakeholders. So this could be shareholders, the consumers, the employers, the suppliers, whomsoever wants, they can make certain inferences. Okay. So now we'll quickly go into the principles, what they are actually. This is the spectrum. So here we have the accounting principle. So they are consisting of the accounting concepts and accounting conventions. Okay. So there are 8 concepts and 4 conventions. The concepts are to be strictly followed, while the conventions are the general trends which are followed universally. So we'll first go with the accounting concepts, which are 8 in number, and let us see it one by one. Money measurement principle is the first principle, which says that all the business transactions are measured in terms of money, which is a common exchange medium. Okay, so whatever you do, ultimately it needs to be converted in terms of the money for the simplicity and for the sake of application of the accounting principles. Because unless and until you are converting them in terms of the money, it will not be easy for anyone to actually know what is the information is being passed on. The next point is separate entity concept. In terms of accounting, the business owner and the business itself, they are 2 different entities. You see, for example, if I create a business, ABC Company Limited, you will think that myself and my company ABC Limited, we both are same. But the accounting principle says that I am different and ABC company is different. So in case I have put up certain capital amount in this company, the company owes that much amount to me, considering me to be an outsider. So this is the separate entity concept. The business owner and the business itself are two distinct entities, and the business is responsible or it owes something to the owner. Okay. The next principle is going concern principle, in which the accounting principles they consider the business to be an ongoing venture which is going to be there for a considerably long period of time, and then this is how you can plan for the future. If you know that the next 2 years your company will not be there, then how can you plan for 5 years down the line? So therefore, it has been considered that a business or a company is a going concern for a considerably long period of time, and that is the basis for being able to plan for long term, 5 years, 10 years, or as per the requirement. The next principle is the cost principle, which says that all the fixed assets, and you know what are the fixed assets? Land, building, plant, machinery, and all these things are the fixed assets. So they are to be reflected at the original cost of buying. So if you have acquired certain machine for rupees 50,000 in the books of accounts, the amount will be reflected as the 50,000, not the market rate, today's market rate, or not something else. Okay, and this also associates with itself the depreciation principle, in which the fixed costs are reduced gradually over a period of time because of the fair wear. So that is the cost principle. Dual aspect concept says that whatever business transaction is taking place, there has to be two aspects. So while for a layman example, I can say that suppose today I give some money to my friend Ram. You may think of this as a one activity. I am giving money to somebody, but in the books of accounts, it's a dual activity, because this activity is having impact on two accounts. One, my account has been reduced for that much amount, while Ram's account has increased for that much amount. So one business transaction is having dual impact on two different accounts. So that is what is the meaning of dual aspect concept. Accounting year concept says that there is a periodicity of accounting. So all of us, we know that from 1st of April to 31st of March is what we know as the accounting period. Okay. Then matching concept says that in case some gain has been identified, if you have been able to generate certain revenue, you must also think of the cost which has been incurred in generating that revenue. Okay, the cost applied is to be matched with the revenue generated. Okay, so suppose you have been able to sell out certain quantity, certain product for X amount, maybe 1,000 rupees. So you must have to consider that what was the manufacturing cost that you have incurred, maybe 800, maybe 700. So that you have to match in order to get the realistic profit. And the last one is realization concept. So no matter when did you get the money, okay, the revenue will only be considered when the product has been passed on to the consumer, or the service has been rendered to a consumer. While you might have got it money in advance, but this is not to be shown as a revenue because you have not been able to fulfill the demand of the consumer. Or similarly, even if you have not received the amount, it is to be reflected as a revenue generation because you have fulfilled the demand of the consumer. So these are all the 8 principles, the concepts which are widely applied across the all countries in the world. Now here are certain conventions. These are the four conventions. Some of them they are mutually contradictory. I mean, if you follow one, you cannot follow the next one with all honesty. So these are four conventions. Consistency is one. In accounting practices and policies, you must be consistent. For example, I'll tell you one example. That depreciation, I have told you, it is the gradual reduction of the value of a fixed asset. So there are two ways of gradual reduction. So if you buy certain components, say for example, if 1,000 rupees, and the given life expectancy is 5 years, so you have to. That means after 5 years, the value of the item becomes 0. So every year you have to reduce 200 rupees as a cost of depreciation. Okay. But in some cases, we are following the diminishing cost method. So in that, what we do, we reduce on a percentage basis. So 1,000 is the cost. So let us think that 10% is the gradual reduction. So 10% you apply for the first year, 100 rupees reduced. Next year, remaining value is 900 rupees. So 10% of that 900 is only 90 rupees. So next year you need to reduce 90 rupees. So whatever accounting practices you follow, it must be followed consistently across the years. So if you have followed the straight line method, you should continuously follow that. If you have followed the diminishing value method, then you should follow the same in the following years. Full disclosure says that all material information to be disclosed. Okay? While all non-material information, which is having little relevance, very small amount of money, either you can ignore it if possible, or you can club them together under a common head, like miscellaneous expenses or preliminary expenses for that matter. Conservatism says all prospective losses are considered. Okay, you need to be pessimistic in it. If some loss may occur, you must show it in the account, although you may not have actually incurred by that point in time. But on the other hand, even though you know that profit will be generated, you will not be including them unless and until your profit has been actually received. And materiality says that all unimportant items are either ignored or merged with the other items. Okay. So this is about the accounting conventions. So I hope this has made your awareness little more improved, little more enhanced awareness. And in the next topic, I mean, during our next discussions, we will be having discussions on further aspects like the statements, the balance sheets, the profit and loss account, the fund flow statements, and so forth. But today it's okay. With that, we sum up. So ultimately, you have known that accounting principles, they are divided into two accounting concepts: 8 in number, accounting conventions 4 in number, and all of them, they are are to be followed in principle universally, so as to gain consistency and uniformity across all the business operations. On that note, today's meeting is over, and I thank all of you for being very kind to me and watching these videos. Again, I request you to do like, share, comment, and subscribe to my YouTube channel for interesting videos. And this is my email ID. You may have a connect with me. Okay. So that's all for the day. Have a nice day. And thanks for watching my video. Thank you.